than that in just a moment. Ankit Agarwal also joins us right now. He's fund manager at Centrum Broking. Ankit, always a pleasure to speak to you. I wanted to start out with two industries where creative destruction, if I may use that word, is actually making things cheaper and cheaper for consumers and making our lives easier, but it's also destroying companies at a pace that, at least in India, we have never seen in the past. And I wanted to start out with banks. I mean, yesterday's move of the Reserve Bank of India has essentially equated small finance banks and payment banks with any other traditional bank, with the exception that you can't take a deposit. But sometimes I wonder what's the big deal, because deposits anyway are growing at 3.3% and facing major competition from everything else. And just to quote you the example of Alibaba, within I think a month or month and a half, it became the largest money market fund in the US. So sometimes it's a question of access to client data than anything else. But just your thoughts, Ankit, are we undergoing a structural change in the valuation of traditional banks?
Yeah, I mean, you rightly said that there are, new payment banks and, small finance banks, they are coming in, and the competitive intensity in the sector is definitely going to go up. How the way we look at it is that, public sector banks, which, traditionally had a significant chunk of, loan disbursements, I think these public sector banks are the ones which will get hit the most. Because they are suffering from capital adequacy issues, they have their own set of asset quality problems, and as a result, for them to grow in the future looks a little difficult. So I think the public sector banks are the ones which are going to significantly lose market share. And we believe that well-managed private sector banks will still continue to grow at the 15-20% rate that they have been. And mind you, a lot of these private sector banks are also adopting to the new paradigms of of fintech, and they are investing in these new technologies. So I think the private sector banks which are more agile and which have a better balance sheet, have lesser asset quality issues, I think they will be in a position to maintain their market share and probably grow from here. But I think the ones who will lose out in this whole in the new paradigm of banking would be the public sector banks, and I think those will be the ones which will lose major amount of market share.
All right. Ankit, we've had the real rally is on the mid-cap side, and a lot of the stocks, yesterday I counted over 100 that were up almost 30% in a week, and dozens that were up about 50%, even a few that were up 70-80%. How do you go around picking these stocks now, Ankit? Because some would say valuations are stretched, but we all know that we reach a particular point in the market where the mid-caps start to become large caps, start to get new institutional buyers. Also, the supply of the stock goes down. So sometimes they can give you 2-3 times returns if we can just keep valuation on the side a little bit, which means I don't mean keep valuation completely on the side, but coming up with some esoteric ratio that PE should be 10 or PE should be 20. If you are to play mid-cap, how would you do it at the moment, and which ones would you look at?
Yeah, so I mean, mid-caps, you have to be a little bit more stock specific in nature. You can't use a generic, brush and sort of look at the mid-cap space on the whole. Even given a sector, you have to be really cognizant of how the company is looking to grow in the future. And if the company is looking at an exponential growth, then probably looking at near-term valuations might, investors might miss out on opportunities. So, we have seen companies, which are going through a sort of a J curve where, they grew at a steady pace, but now they are at that inflection point, when the company's numbers and revenues could really see a stark up move. And one needs to really look at these stocks on a more stock specific basis. And some of the sectors where we believe that the companies which were a little bit more regional specific are going more pan India, they have the triggers to grow even going ahead. And valuations probably in the near term might look a little bit expensive, but if any investor is looking at a 3 to 5 year period, then these companies could provide you, significant returns. So there are companies in the consumer discretionary space in India which, which are more region specific, which are looking to expand significantly. There are banks and NBFCs, which are which have a much smaller book and much smaller regional presence, and they are looking to significantly expand. There are companies in the specialty chemical space, which are seeing a lot of business moving out from China to India, specifically because of environmental concerns in China, and India being a good second source of supply for a lot of the MNC clients. So you are seeing a lot of companies which are present in these spaces, which are doing well, and our expectation is that these companies could significantly scale up over a period of time, and hence provides you a good opportunity, even if the near-term valuations look a little bit expensive.
Ruchit. Right. Ankit, your thoughts on iron and steel. I'm sure the companies are in some kind of pressure, and but my thought is sometimes you have to also look at these industries as cyclical, and suddenly the cycle changes. And we're also putting all these stocks in the same lot. So whether it's a Sunflag or a Visa or whoever else, but many of them manufacture very different stuff. And prices are not moving together for cold rolled, hard rolled, or other kind of steels. Your thoughts?
Yeah, I think we were much more comfortable taking a valuation call in some of the cyclical space, somewhere when we were sitting in Feb and March of this year. But if I look at the metal space as a whole, it has seen a significant rally in the last 6 months. The metal index has given in excess of 30-40% return in the last 1 year, and at current prices probably will not be so comfortable to get fresh into something like iron, steel, or the metal space, specifically because like you rightly said, it's a cyclical space. One can't really predict how the global prices are going to move. They are dependent a lot on how the global macros pan out, and if you see the global situation today, things are not looking too great in Europe, Japan, and even China. So there was a valuation call that one could have taken in and around Feb, March, but now probably will not be so comfortable getting fresh into the iron, steel, or the commodity space in general.
All right, Ankit, thanks very much for joining us. Ankit Agarwal, Fund Manager at Centrum Broking. Ruchit,